Obviously, not all tech stocks think alike when it comes to trade. How are you seeing the mix fare with some of the recent headlines we've seen on trade?
Well, it's a problem that just doesn't seem to want to go away. And frankly, even if we get a mini deal, I think there's a real long-term factor here, which is the U.S. is going to be at loggerheads with China for a long time. China is working really hard to create an indigenous technology industry that's really helping the semi-cap names right now because over 20% of their revenue is selling to the Chinese. But a lot of the rest of tech is suffering, and some of the chip companies are waiting to see how much they can or can't sell to Huawei. So right now we're market weight tech. We are underweight semis. Yesterday went to an overweight on software selectively. So as you say, it's a mixed bag out there.
Overweight on software, why? What was the calculus that caused you to upgrade that subsector?
Well, the secular trends are obviously quite good, and the group has underperformed over the last 3 to 6 months as semis has really outperformed. So we're looking for semis to come in a bit. They're at a very PE high historically. Software, you still have a lot of companies selling at 10 times revenue. We don't really want to touch those. But some of the bigger cap names look reasonably attractive. So Microsoft, ServiceNow, Salesforce, Akamai, maybe VMware. So there are names that we think look reasonable here. But we're basically looking for software to continue to come back after underperforming much of the year.
And with regard to internet, we spoke a little bit earlier about some of the FANG names getting upgrades today. Is FANG attractive to you still largely, or no?
I think FANG is. Internet in general had a horrible earnings period, and a lot of the mid-cap e-commerce platform names like Pinterest and Etsy and Twitter really had a tough time, and the stocks have taken a header. But part of their problem was losing share to the Facebooks and Googles of the world. We've maintained that the thing that really concerns me about those stocks longer term would be technology disruption. And I don't see that yet. Some of the new trends like AI, they're the leaders in. So in the meantime, the regulation cloud will probably continue, probably limits upside in terms of their ability to do M&A. But the stocks are relatively inexpensive. And the government even seems to be coming to their aid to some degree, fighting France on the digital taxes, concerned about competing longer term with the Chinese, Tencent and TikTok and so forth. So we continue to think those are appropriate names.
Steve, some of the software names that you like, you named a few of them. Microsoft, there's Salesforce, ServiceNow, Palo Alto, VMware. I notice you've listed. They're really depending on corporate spending, enterprise spending, which when it comes to hardware has been a little touch and go lately. I wonder what trends you think are going to power those higher. Is it a shift in spend away from hardware toward these, or do you just think that the sorts of services they offer are so essential that they're going to continue to see benefit no matter what happens in the macro environment?
There certainly is a secular shift away from hardware to software and services, which has been going on for more than a decade, certainly. But I do think that what they're selling is extremely important. As you pointed out, the hardware companies in particular are seeing some of the big enterprises backing away here, having some concerns about committing more capital. That could affect software, particularly if the economy gets significantly worse here. Workday and a few others have talked about maybe some issues, but in general, particularly if you're moving to the public cloud, you're going to have to deal with Amazon, Microsoft, Google, digital transformation. You're going to have to deal with Salesforce and a number of these folks. So I think, again, the larger names are in a pretty good position because digital transformation isn't going to take a vacation.
Steve, I want to bring in Tom Forte of D.A. Davidson. He's a senior research analyst there into the conversation. Tom, we were talking a little bit earlier with Steve about this idea of you've got this digital tax fight now, which may imply some sort of an alliance between the Trump administration and some of these large tech companies. How do you see some of the recent developments on that front shifting the potential for regulation of big tech these days?
Sure. So I definitely think that for the four horsemen of big tech, Amazon, Apple, Facebook, and Google, regulatory risk on a global basis is very important and must be monitored. But to your point on France, I think, and if you look at actually the tariff situation between the U.S. and China, to the extent that the U.S. government is trying to get the Chinese government to honor intellectual property, that's beneficial for big tech firms. So to the extent that you might see some tariffs on French goods as a combating the digital tax there, that also could be beneficial for big tech, most notably Amazon. So not all the tariff moves are necessarily bad for big tech. Just some of them may take a long time to play out.